I created a short musical video that breaks down this powerful concept in a fun and easy way. Watch it on YouTube and see how small daily investments can turn into millions over time. That $1.3 million from portfolio number 2.
All right.
It might seem small compared to the $4.6 million, but think about it. That initial $75,000 you saved grew 17 times over. That's a 1,700% return.
And here's where it gets really interesting. A staggering $1.2 million. That $1.3 million came from the magic of compounding.
Wow.
That means a whopping 94% of the growth came from simply letting your money grow over time. It's the snowball effect in action.
Turning finance into a beat, music and wisdom for you and me.
Good day, aspirational millennials investors. Welcome to the Deep Beat Financial Edutainment channel for aspiring investors. We turn complex finance into music and wisdom for your ears and brain. This is King John, the host of the Deep Beat channel.
I'm Jan Malton, co-host of the channel.
Remember to subscribe to our channel. We will deliver the most complicated financial and investment concepts
into music and wisdom for your ears and brain. This podcast runs for about over 16 minutes, and we've divided it into 3 episodes
with short breaks roughly every 6 minutes to make it a smoother and more enjoyable experience. Today, we're diving deep into a concept that's both simple and incredibly powerful. $7 a day doesn't sound like a lot, does it? Feeling like a fancy coffee or a quick lunch. But what if I told you that if you invested every day for 30 years, that $7 a day could turn into millions? Pretty tempting, right? Makes you wonder if it's too good to be true. So today we're going to do a deep dive into this whole $7 a day to millionaire thing.
And
really see if it actually makes sense. We've got some examples of like portfolios and a financial analysis that breaks it all down. I created a short musical video that breaks down this powerful concept in a fun and easy way. Watch it on YouTube and see how small daily investments can turn into millions over time. Okay, let's start with some basic math. Saving $7 a day is $210 a month, or $2,520 a year.
okay.
Over 30 years, that comes to $75,600.
Great.
Let's just round that down to $75,000 for simplicity.
Now, before we pop the champagne on that $75,000, we need to address the elephant in the room.
Yeah.
Inflation. The value of money changes over time. When you could buy with $75,000 today, it won't get you the same things 30 years from now.
Inflation is a sneaky thief silently chipping away at your savings.
It really is.
Yeah.
If we use a conservative average annual inflation rate of 2%, that $75,000 saved over 30 years would only have the buying power of roughly $41,000 today.
Wow.
So even though you've saved a good chunk of change, inflation has eaten away a big portion of its value.
It's a sobering reality check.
Yeah.
It highlights that simply saving might not be enough to reach your financial goals. Especially those ambitious ones, like $1 million.
Exactly. That's why investing is so crucial.
Yeah.
It's not just about stashing cash under your mattress, it's about making that money work for you.
The potential of long-term investing, even with small amounts.
Yeah.
You always hear about saving money, which is super important.
Right.
But what if saving alone isn't enough to hit those big financial goals, like becoming a millionaire?
Well, that's where the magic of investing kicks in. If you invest, your money has the potential to grow faster than inflation, and compounding is what really makes that happen. Let's look at some real-world examples.
If you're curious about how a $7 daily investment can grow into millions with real stocks over 30 years, check out my in-depth explainer video. I break it down using real market data, showing you the step-by-step process and key insights you need to understand.
Okay, let's revisit into it again. One portfolio invested mostly in some of those big tech companies, Apple, Microsoft, along with Walmart. After 30 years, it had grown to $4.6 million.
Million? That's like life-changing money. Did the other ones do that well too?
They were still impressive, but not quite as dramatic. There was one that focused on some well-established companies, Oracle, Coca-Cola, United Health Group. That one ended up at $1.3 million. And then another one that included all of the stocks we've talked about ended up at $3.1 million.
So even the one that did the worst still turned $75,000 into more than $1 million.
Yeah.
That's crazy compared to if you just saved it, because then inflation would have shrunk your money, like you said. It really does seem like this $7 a day plan could work.
Yeah.
But let's take a closer look at $1.3 million from portfolio number 2.
All right.
It might seem small compared to the $4.6 million, but think about it. That initial $75,000 you saved grew 17 times over. That's a 1,700% return.
And here's where it gets really interesting. A staggering $1.2 million. That $1.3 million came from the magic of compounding.
Wow.
That means a whopping 94% of the growth came from simply letting your money grow over time. It's the snowball effect in action. Earnings on top of earning.
Wow. So instead of that $41,000 you would have had if you just saved the money, you end up with $1.3 million by harnessing the power of compounding.
Right.
That's a huge difference.
It's the difference between preserving wealth and actively growing it. Starting early and letting your investments compound over time can make a world of difference.
Now, before we get too carried away with these impressive results,
Yeah.
let's revisit those challenges we talked about. Remember, this 30-year journey wasn't all sunshine and rainbows,
Definitely not.
but I'm guessing there's got to be a catch.
Yeah, there's always a catch.
Stay tuned, folks. We will take a break for the first episode. When we come back, we will discuss how to deal with stock market volatility and drawdown.
Wisdom for you and me.
We are back again.
One thing that people don't really think about is how volatile the market can be.
Yeah.
And I don't just mean, ups and downs. I mean, sometimes it drops a lot. And those are called drawdowns.
Drawdowns sounds kind of scary, like falling into a hole.
It is kind of like that. It's a bit like a roller coaster. It's exciting, but sometimes your stomach drops. And the data from these portfolios shows just how big those drops can be. Remember that one that was mostly Apple and Microsoft and it could so well? Well, from 2000 to 2004, it actually lost almost 50% of its value.
Seriously. Yeah. So even with those really big companies, you could have lost half of your money. That's kind of terrifying.
Yeah, it is. And it shows what investing for the long term really means. The market doesn't just go up. In fact, all of the portfolios had times where they dropped by 30% or more. So that's the kind of volatility you have to be ready for if you're in it for the long haul.
Yeah, I'm starting to get why those numbers don't always tell the whole story. It's one thing to know that the market can go down, but it's another thing to imagine losing like 30% or 40% or even half of your money.
Right, and that's where the psychology of investing comes in. Our emotions like fear and not wanting to lose money can really get in the way of our long-term goals.
Loss aversion. That's that thing, right, where it feels way worse to lose money than it feels good to gain the same amount. Like losing a $100 bill is worse than finding a $100 bill.
Exactly. And because of that, those times when the market drops can feel really bad. And sometimes people make decisions that they wish they hadn't later on.
So it's not about like being weak or undisciplined. It's about understanding how our brains work.
Exactly. And it's even more complicated than that. There's this thing called myopic loss aversion. It basically means the more you look at your investments when they're going down, the more scared and anxious you're going to feel.
Oh yeah, I do that all the time. It's like, I can't help myself. I keep checking my investments, even though I know it's just going to make me stressed.
It's totally normal. But it can lead to something called panic selling. That's when you get so scared that you sell everything at the worst possible time, and then you lose money and miss out on any gains that might happen later.
This $7 a day plan is sounding a lot different now. It's not just about picking the right stocks. It's about being able to handle it when things get rough.
And
Honestly, I'm not sure I could do it.
that's a really important realization. It all comes down to this. The real challenge isn't picking stocks, it's staying invested.
So you're saying even if I knew exactly which stocks were going to do great over the next 30 years, it wouldn't matter?
Not necessarily. The most important thing is to have a plan and stick with it even when it feels scary and everyone else is freaking out. That's why having an investment plan is so important, a plan.
So like a roadmap that tells you what to do when the market is going crazy.
Pretty much. A good plan is going to outline your goals, how much risk you're comfortable with, how long you want to invest for, and how you're going to diversify your investments. It's basically like having a set of rules to help you stay focused on the long term, even when things are crazy in the short term.
Okay, so it's not just about putting money in the market and hoping for the best. You really have to be strategic about it. Speaking of strategy, can you tell me more about diversification? I hear that word a lot, but I'm not really sure what it means.
That diversification is basically spreading your investments across different types of assets, like stocks and bonds and real estate and maybe some other stuff too. It's like that saying, don't put all your eggs in one basket.
So if some of my investments are doing badly, others might be doing well. And that helps protect me overall.
Yeah, exactly. Diversification helps reduce your risk because your whole portfolio isn't dependent on just one thing.
That makes sense. It's like having a backup plan just in case one part of the market crashes. But how do those portfolios we talked about earlier fit into this?
Well, all of those portfolios had different stocks from different parts of the economy. So they were already diversified in a way. And that's one of the reasons they did so well over time.
So even if I'm only investing in stock, I should still try to pick companies from different industries.
Right. For example, when the pandemic happened, travel and hotel stocks went way down, but tech stocks went way up. So if you have a diversified portfolio, you're more likely to have some investments that are doing well no matter what's happening in the economy.
I'm starting to see how important diversification is for managing risk. But let's go back to this $7 a day thing. It sounds good, but it also seems kind of hard. What if I'm not ready to start with that much?
That's totally fine. The important thing is to just start, even if it's with a small amount. Compounding works best when you start early and keep going, even if you're only investing a little bit.
So it's more about making it a habit than about how much money you invest.
Yeah, exactly. And you'd be surprised how much even small amounts can grow over time, thanks to compounding. Investing isn't about getting rich quick. You have to be patient and disciplined and be prepared for the ups and downs.
So we've talked about how you could turn $7 a day into millions, but we've also talked about all the challenges that come with it. So what can we learn from these investors who successfully navigated those turbulent times? What strategies helped them stay the course?
This is the second short break for the second episode. After the break, we will discuss more about strategies of long-term successful investors and enjoy another part of the song created by King John.
Can saving $7 a day make dreams come true? In 30 years time, it's up to you. $7 daily, that's $210 a month. 2,500 yearly, it's not just a hunch. But factor in inflation at 2%. 41.
Here are the lessons from the long-term successful investors. The one key takeaway is the importance of having a clear investment plan. This plan should outline your financial goals, risk tolerance, and time horizon.
It's like having a roadmap for your financial journey. It keeps you on track and prevents you from making impulsive decisions based on fear or greed.
Another crucial factor is understanding and accepting market volatility. Downturns are inevitable. Don't let them derail your long-term plan.
It's easier said than done, though, right? Seeing your portfolio drop in value can be really unsettling, even if you know intellectually that the market will eventually recover.
You're absolutely right. That's why having a long-term perspective is so vital. Remind yourself why you're investing in the first place. Are you saving for retirement, a down payment on a house, your children's education? Keeping those long-term goals in mind can help you ride out those temporary market storms.
It's like running a marathon. You hit some hills along the way, but you don't stop running just because the terrain gets tough. You keep your eyes on the finish line.
That's a great analogy. Well, one crucial aspect is managing your emotions. Investing is as much about psychology as it is about numbers.
I think it's something a lot of people overlook. We tend to think of investing as a purely rational endeavor, but our emotions can play a huge role in our decision making.
Absolutely. When the market takes a nosedive, fear can kick in, leading us to make impulsive decisions that we later regret. On the flip side, when the market is soaring, greed can take over, causing us to chase after those hot stocks that everyone is talking about.
So how can we keep our emotions in check and make sound, rational decisions even when the market is throwing us curveballs?
One helpful technique is to focus on the facts and data rather than getting swept up in the hype or the doom and gloom. Look at the fundamentals of the companies you're investing in. Are they profitable? Are they growing? Do they have a solid management team?
It's like tuning out the noise and focusing on the signal.
Exactly. Another strategy is to limit your exposure to financial news and social media. The constant barrage of information can be overwhelming and anxiety-provoking. It's often better to step back, take a deep breath, and remind yourself of your long-term goals.
It's like taking a digital detox for your financial well-being.
Another helpful approach is to automate your investments. One thing that can help a lot, especially if you're just starting out, is dollar cost averaging.
Dollar cost averaging. I've heard of that, but I don't really know what it is.
It's actually pretty simple, but it works really well. Basically, instead of investing a bunch of money all at once, you spread it out over time. So you buy like the same amount every week or every month, no matter what the price is doing.
So like with the $7 a day plan, I wouldn't try to figure out the best time to buy. I would just invest $7 every single day, even if the market is going up or down.
Exactly, and there's some good reasons to do that. First of all, it takes the emotion out of it. You don't have to stress that when to buy or sell. And second, it can help you get a better price overall. By setting up a regular investment schedule, you take the emotion out of the equation. You invest consistently, regardless of what the market is doing.
It's like setting up a financial autopilot that keeps you on track, even when you're tempted to deviate from your plan.
And finally, don't be afraid to seek professional guidance. A financial advisor can provide objective advice, help you develop a personalized investment strategy, and offer support during those times when the market gets rough.
It's like having a financial coach in your corner, someone who can help you stay focused and motivated even when things get tough.
Now remember the seemingly obvious winners in our portfolios like Apple, Microsoft, and Walmart. Even selecting these companies wasn't a guaranteed slam dunk back in 1994. Let's take Apple as an example.
Okay, back then, Apple wasn't the tech behemoth it is today. They were struggling, facing intense competition. What made investors believe in their potential?
Well, even in those challenging times, Apple had a loyal customer base and a reputation for innovation. Investors who saw the long-term potential of their products and brand were willing to bet on their future success despite the short-term headwinds.
So it wasn't just about looking at the company's current financials. It was about understanding their vision and their ability to adapt and evolve.
Precisely. And that brings us to another crucial aspect of long-term investing: patience. Building wealth takes time. There will be ups and downs along the way. But those who can stay the course, who can resist the urge to chase quick profits or panic sell during downturns, are the ones who are most likely to achieve their financial goals.
It's about playing the long game, recognizing that slow and steady wins the race.
Absolutely. And remember, even the seemingly small daily investments of $7 can compound over time into something truly significant.
Now, a final short break. Let's see what the final advice for aspiring long-term investors.
And remember, everyone's different. You have to find what works best for you, your risk tolerance and your goals. We've talked about a lot today, like how you could potentially turn $7 a day into millions, but also how risky and challenging it can be.
Yeah, it's been a crazy ride. I started out feeling excited, but now I realize you have to be really realistic about investing and think about the risks.
That's really important. It's easy to get sucked into those get-rich-quick schemes. But investing is a lot more complicated than that. It takes time and discipline, and you have to be okay with the ups and downs.
So to sum it all up, or the one thing you want our listeners to take away from all of this?
I think the most important thing is this: investing for the long term can really pay off, but you have to understand the risks and be prepared for the challenges. It's not just about following some magic formula. You have to make a plan that works for you and your situation.
And even if $7 a day seems like too much, don't give up. Just start with something, anything. The important thing is to make it a habit. You can use things like dollar cost averaging to reduce your risk. And remember, you don't have to do this alone. There are lots of resources out there that can help, like financial advisors and websites and books.
That's right. Investing can seem intimidating, but if you learn about it and keep learning, it can be a really great way to build a secure financial future. Remember, even a really long journey starts with just one step. So take that first step and keep going. And as we wrap up this deep dive, we want to leave you with this thought. Investing isn't just about building wealth. It's about empowering yourself to create the future you desire.
It's about taking control of your finances and shaping your destiny.
So remember, what could your $7 a day become? The possibilities are endless.
Thank you for your time. If you're interested in exploring more content, feel free to check out our other videos on the Deep Beat YouTube channel. Stay tuned for our next podcast episode, where we'll be diving into the topic of market capitalization.